Well, let's digest these numbers with Sal Guatieri, these inflation numbers. He's director and senior economist at BMO Capital Markets. And again, what we can tell viewers is that core inflation, if you measure it on a so-called trim basis or a median basis, has come in, I think, materially more than economists had expected in terms of a survey by Bloomberg News. Also, those numbers have come in at levels that are higher than the November numbers, and the November core median number has been revised higher as well. Sal Guatieri, what do you think of these numbers?
Well, for the second straight month, it's a bit disappointing that we're seeing a little more inflation pressure than many analysts anticipated. Now, the headline number was on expectations at 3.4%. But you're right, those two core measures that the Bank of Canada tends to follow the closest, the trim and the median, were actually up in the month. And they were anticipated to actually decline in the month. Now, I guess removing the sting somewhat from this report is that a couple of other core measures that the Bank of Canada used to monitor pretty closely, just the straight CPI excluding food and energy, that did show a lower rate of inflation. And another core measure, so-called CPI-X, which is CPI excluding 8 volatile items and indirect taxes, that also showed a slowing in underlying inflation. So a bit of a mixed bag really will come down to what the Bank of Canada continues to pay the most attention to in the inflation report. So disappointing, but not quite as bad as perhaps at least those two core measures suggest at face value.
Can you briefly explain, Sal, the difference between the core trim measure and the core median measure? And is there one that the Bank of Canada pays particularly more attention to?
I believe the Bank of Canada pays a little more attention to the trim measure. So that's just taking out most of the most volatile items from that basket, the outlier items. The median, as its name implies, is the middle price in that basket. They're both very reliable measures of the underlying trend of inflation, perhaps a little better than just straight CPI excluding food and energy, for example, or just stripping out the 8 most volatile items. But again, I think you have to put all the core measures together, and I think the Bank can actually will do that to come to some assessment on what the true underlying trend in inflation is. The bottom line seems to be that we've hit a bit of a stall now in the downward trend in inflation for the second straight month, which is a little concerning. Now, the good news is we're all the way down from headline inflation of over 8% in the summer of 2022. But we still have a long ways to go, obviously, to get back to 2%. We've always said that last mile back to the 2% target would take a while, may take until the end of this year, perhaps even a little longer, into early 2025 before we get really close to the 2% target. Now, of course, the Bank of Canada doesn't have to wait until we get down to 2% before they can cut rates. But this report certainly squares a little more with our view that the Bank of Canada will probably delay rate cuts until June of this year, as opposed to moving a bit earlier as the market was anticipating.
Sal, if we looked actually a little deeper at core median there as an example, was there just one or two things that really soured the apple cart that were the biggest surprises in your mind?
Well, I don't have any information on the details, on the components. Now, we do know that rents have been a real bother for inflation and for the Bank of Canada. We're seeing ongoing upward pressure on rents across Canada, partly because of very strong population growth, but also because the ownership market is so unaffordable that many people are forced to rent. That's pushing up rents, and that's a big component of the CPI basket. So that's a big problem. The other area, and the Bank of Canada has raised this as well, is wages. We are seeing ongoing wage pressures in Canada that are not, unlike in the U.S., offset by stronger productivity growth. In fact, productivity has been shrinking in Canada. So that's a problem because it means that businesses are a little more compelled to raise prices to cover those higher wage costs. And that's been an issue for the bank as well. So all of these, both of those components anyways, do suggest some stubbornness to inflation or stickiness. And that's why we've always held to the view that it may take some time, at least another year, before we get close to that 2% target.
And to your point, Sal, the table of different components of the basket show that shelter costs rose by 6% in December versus December of the prior year. One of the strongest contributors, I think the strongest contributor in the entire CPI basket to cost. People often make the point that there's a bit of a feedback loop. One reason shelter costs are high is that mortgage rates are high, and one reason mortgage rates are high is that the Bank of Canada rate is high. Can you comment on that? How stubborn are shelter costs going to be? How difficult is the task of bringing down shelter costs when they are so tied to the Bank of Canada interest rate?
Well, that's also part of the problem, is that mortgage payment costs have gone up across Canada ever since Bank of Canada began raising interest rates. And they are expected to keep going up for a while because so many more households need to refinance their mortgages at obviously higher interest rates than when they undertook that mortgage. So that will be a source of ongoing stickiness in inflation. I think the Bank of Canada is well aware of that. It's probably, in some sense, stripping that out of its underlying view of inflation. But the bigger problem, as you mentioned, is overall shelter costs, in particular rents, because say rentals.ca, their latest asking rent price is up about 9% in the past year to December. And again, that's actually showing signs of increasing as opposed to decelerating. So we could see rents continue to put a lot of upward pressure on inflation for some time. Now, the important thing is we need to see other areas, other components of inflation moderate, and they should. The unemployment rate is up almost a percentage point from its low. So that should take some heat off of wages and discourage companies from increasing prices. And we do expect the unemployment rate, unfortunately, to go up almost another percentage point this year because of the weak economy and very strong labor force growth. So we will see lower wage pressures and lower inflation, but because of rents, for the most part, that ride back to 2% will take a while.